So welcome back. Let us take another advanced option strategy, and that is called as a strangle. Now a strangle is similar to a straddle, what we have just studied in the previous lesson. Both are similar, but there is a slight difference. What is the difference? Let us try and understand that. See, in case of a straddle, you had sold the call and put of the same expiry at the money, isn't it? Now in case of a strangle, you will be doing the same thing, but slightly out of the money. Yeah, little left and right. That means what? That means you will sell a call option at a slightly higher price, say 105, and sell a put option at a slightly lower price, that is 95. Alright, but both at the same expiry. Try and understand the concept. Alright, little left and right you have got. So what would happen in the earlier case, in case of a straddle, when you had sold the ATM, that time the premium that you had got was $5 on each leg. That means $10 premium you had got, isn't it? But now, because you are going out of the money, your premium will be slightly less. Let us say $3. So you will get only $6. Don't go on these figures. The figure 10 and 6 is just to explain to you that in case of a straddle, the premium was high. In case of a strangle, the premium is less. That is all. Alright. Now try and understand this. By moving the strike price from ATM to OTM, moving little left and right, what have you done? You have increased the safe zone marginally and increased the breathing space in case of a strangle. Here in straddle, the breathing space was less. Here the breathing space is little more. That is what you have done. You have increased the safe zone. But the maximum profit has been strangulated from 10 to 6. Some compromise, some strangulation on the profit. That is what you have done. Alright. That means what? That means that even if there is some volatility in the price movement, even if the price goes little left or right, you will still remain safe. But your profit gets strangulated. Try and understand. Alright. Now, like a short straddle, here also what you have done, you have shorted a call and a put option. Therefore, you will call it a short straddle. Earlier you had called it a short straddle. Now you will call it a short straddle. In a straddle, you had a very narrow safe zone, but a higher profit as premium. Yeah. In case of a strangle, you have got a little wider safe zone, but the profit is strangulated. I am repeating it, but it is necessary for you to understand the concept. Alright. Remember that in both the cases, whether straddle or strangle, the profit is limited to the premium that you take, but your losses can be unlimited in both the cases. And remember that like a short straddle, a short strangle is also good for a stable market or a sideways market. Alright. Now let us try and understand the long straddle. Alright. Short we have understood. Now we'll understand the long straddle, opposite of that. So it is similar. Here what do? You go long on a call option at a slightly higher price, 105, and you go long on a put option at a slightly lower price. Similar thing, but inverted, both at the same expiry. Alright. So here you have provided more breathing space to the opponent as compared to the straddle. Who is your opponent? Here you are going long. So the person who has gone short in the strangle, he is your opponent. To the opponent, you have given more breathing space, isn't it? So what do you get? You get the benefit of paying slightly less premium. Earlier you had paid $10 as premium. Now you will pay $6. It is a level playing field for everybody. You have provided some benefit to the other person, so you also get some benefit here. Got it? In a long straddle, your premium was 10, which you had paid. Now you will pay only 6. But remember that in both the cases, the loss is limited to the premium that you are paying, but your profit remains unlimited here because you are going long, a long strategy, unlike the short one. Try and understand the concept. Long straddle is good for a volatile or a turbulent market. Only if the price goes left and right, then only you will gain. Got it? So I hope the concept of straddle and strangle is now very clear to you. Let us just quickly recapitulate them because they are similar. So if you are trading ATM strike price, then it is a straddle. If you are trading slightly OTM strike price, then it is a strangle. Got it? If you are shorting the call and put option, then it is a short straddle or short strangle. If you are going long, then it is a long straddle or long straddle. As simple as that. When you are shorting, the profit is limited, but loss can be unlimited. When you go long, the loss is limited, but the profit can be unlimited. Very interesting aspect. Try and understand it. When you are shorting, you get the premium, you take the premium. But when you go long, you have to pay the premium. Isn't it? In case of a straddle, the premium is higher. In case of a strangle, the premium is low. Why? Because the breathing space increases. Alright? Wasn't it very simple? More of it we'll see in the next lesson. Alright?